Hello, everybody. Welcome to this webinar brought to you by Kenanga Investment Bank in collaboration with Bursa Malaysia. And this webinar is managed by our company, Wellford. So today, our webinar's title is Stock Picking Insights. Now, before we begin the webinar, allow me to give a shout out to the Kenanga Humankind Project. It is a CSR project undertaken by Kenanga Investment Bank to help the needy to afford the meal. All right. So what Kenanga Humankind Project is all about is that we would like to urge you to pledge a meal at 20 ringgit. And for every meal that you pledge, Kenanga will match it meal for meal. So at least 2 persons will not have to go hungry. And this meal this contribution will be able to sustain employment opportunities for the disabled employees at Cafe Includes, and it provides training and development to disabled employees at Cafe Includes. All right, so the meals will be distributed to children in need. So the goal is to raise 3,000 ringgit for approximately about 2,500 meals to be given out to the children in need, right? So this is a project. If you feel like you want to contribute this cause, please scan the QR code at the bottom right corner where you can pledge a meal at 20 ringgit to children in need, and helps to sustain employment opportunities for disabled employees at Cafe Include. All right, so this is a quick shout out for Kenanga's Humankind Project. Now, disclaimer, for this webinar, whatever we share is only for educational purpose. So in no way that we give you any recommendation for you to buy or sell any listed securities that we mentioned here. So if you decide to make any investment decisions, you're 100% responsible for all your investment risk. All right, so today our topic here is stock picking insights. So as the title suggests, today we are going to delve deeper into the various research methodologies that are used to evaluate stocks. Okay, today our topic is very unique, and I really love this topic for us to see, the behind the scene work on how research analysts, what kind of methodologies do they employ to evaluate stocks and securities. All right, so we'll look at stocks from the fundamental analysis point of view, technical analysis point of view, and other unconventional methods of evaluating stocks. All right, so today we are very honored and very glad to have invited the senior analyst from Kenanga Research, who is Mr. Goh Yin Foo, to come to our session and share with us stock picking insights. All right, Mr. Yin Foo, how are you?
Hi, hello everyone.
Good to have you here today.
Yeah, thanks for having me.
All right, so I may hand it over the session to you.
Okay, let me share my screen.
Fantastic.
Many thanks for joining this Can Trade webinar, and good evening to all. It's nice to be back here speaking tonight, notwithstanding the bearish market mood out there. The last time when I spoke was in March this year, and coincidentally, the stock market was also jittery back then. Perhaps I should request to be asked not to give more any talk after this. In any case, today's webinar titled Stock Picking Insights is educational in essence. And I believe that it's always relevant for us to equip ourselves with additional skill set, as the learning curve is never ending in a dynamic stock market environment. The webinar material hovers somewhere between the basic and intermediate level. For those who are a little bit more knowledgeable, you may take this as a refresher, especially in the first half of the session. But I do hope to share some fresh insights towards the later parts of the webinar. Here's what I intend to cover for the next hour or so. We will begin with showing an overview of the investment universe. And thereafter, we will dive into the various stock market research methodologies. it will consist of the more conventional approaches like fundamental analysis, technical analysis, and from there we would spin out to cover a bit more the less conventional methods, which includes behavioral finance as well as trading systems. And last but not least, I will round up with highlighting what are the key challenges when it comes to stock picking, as well as hopefully there are sufficient key takeaways for everyone to go home with today. Okay, let's kick off by talking about the big picture and overview of the investment universe. And I think this is a very relevant, very applicable in today's context, where we can actually think back to what's happening in the global investment landscape as we speak. When it comes to investment, to state the obvious, we can actually park our investment into many asset classes. And this will range from equities, fixed income or bonds, commodities, properties, alternatives like private equities or cryptocurrencies, foreign exchange, as well as cash. Now, why is it important to understand this is that these asset classes are all interlinked in the sense that what's happening in one asset class would obviously can affect another asset class. And as we all know, what's happening in today's financial markets is that the US is increasing interest rates very aggressively, very fast, and it is still an ongoing process. As a result of that, you can see that money is actually flowing back to the US. And because of that, the USD, again, everyone of us is well aware that the USD has strengthened across the board, and that has also led to the reverse of that would be a weakening of the various currencies. Our very own ringgit has depreciated more or less about 10% since May of last year, and some other currencies has actually depreciated even more. The likes of Japanese yen, euro, and British pound. And because of the increasing interest rate as well, we saw how the bond prices have actually tumbled so far this year, and increasing interest rate is also bad news for the stock markets. So from there, we can actually see that the interlink among the asset classes would have an impact on another asset class, and it is very important as investors when we want to invest in a particular asset class to be aware and mindful of what's happening in other asset classes. We also need to understand who are the major players in the stock market. And broadly speaking, they can be categorized in three categories. Number one would be the institutional investors. Number two will be the retail investors, people like you and I. And number three will be the other type of investors. Example, the traders, the major shareholders of listed companies, and the banks. And why is that important to understand the investment profile? Now, if you understand that a vibrant stock market, regardless of whether it is in a bull run or a bear market, there will always be buyers and sellers. And why is that so? It is because of the stock market is made up of players in various categories. And these players are all operating based on several criteria. The first criteria that we need to be aware of is the investment horizon. Different investors would have a different investment horizon, and this can be categorized into long-term investors like the pension fund, like the insurance fund. Medium-term horizon would be the likes of the unit trust, and short-term horizon investor would be the day traders and so on and so forth. And each of these investors, they would have their own investment objective, right? Some would be capital preservation, like the sovereign wealth fund or the pension fund, like our EPF. Some would be more income-oriented, like the dividend fund, and some would be more aggressive, like the traders. And each of them, again, they would have their own constraint. So that's why even if in the worst of time, when everyone is so pessimistic, there will still be buyers out there in the market, simply because some of these investors, like the institutional investors, they are not allowed, their mandate will not allow them to hold 100% cash. So they will still need to buy some stocks and hold them in their portfolio. And also where the investors differ would be the investment target, right? Some funds, especially the institutional investors, you would see that their target is to beat the index, which means they are looking at relative return, whereas some other funds or individual investors, they are looking at absolute return as their investment target. And when we talk about returns, we also need to talk about risk. The institutional investors and the conservative retail investors, they are more risk averse, but the risk takers would be the hedge funds, the likes of the hedge funds and the day traders. This is essentially an overview of what are the major methods that investors normally use when talk about stock market research. The most common one would be what we call the fundamental analysis, which you can actually do a top-down approach, like what's happening now. We do an economic analysis. Are we heading into a recession? If yes, is it going to be a deep recession or a shallow recession? Is it going to be a long recession, or is it going to be a short recession? And within this big picture, which are the industries that will be more badly affected, and which industry will be less affected? And from there, we drill down to the company analysis. Which company would actually benefit, or which company will actually be affected. The next method will be the technical analysis, where we talk about charts, patterns, indicators. More on this later on. I will also touch very briefly on investor psychology, which also includes behavioral finance. And there will also be some spin-off methodologies, such as algo trading and trading system. Even some investors today, because of the commission rate is so low, they can actually just trade based on news flow. Like, for example, if a company announces very strong results, they may just want to trade on that news piece of news. Okay, let's start by taking a look on how does a fundamental analyst goes about when, in terms of recommending stocks. Broadly speaking, they will be looking for information, and this information can come from multiple sources, like the listed companies' annual reports, company announcements, going to meet up with management, talking to reading newspaper, talking to the competitors in the same industry. And from there, the information gathered, we will be looking at crunching the numbers to do a financial statement analysis, valuation analysis, using various forecasting techniques and all that. And at the end of the day, you would get to read the summary of all these findings in an investment report, whether is it a buy or is it a hold or a sell. When it comes to looking at companies or stocks from a fundamental perspective, what are the key criteria that normally we look at? And a very good analogy would be if we put ourselves in the shoes of a business owner. Let's take, for example, if you are a owner of a restaurant or F&B outlet. So what would you want to look out for? So in a best case scenario, we would want to look for a business that continues to show sustainable earnings growth. Not only earnings are growing at a sustainable rate, and they must be also earnings quality, meaning to say that the earnings are actually increasing not because of asset disposal, but because of the operation of the business. And in addition to that, the first 3 points talk about the profit and loss account. In addition to that, we also need to look at the balance sheet, how healthy financially a company or business is. And as investors, when we invest in the stock market or when we buy shares in a listed company, there are only two forms of returns that we look out for. One is capital appreciation, and the other obviously is dividend returns. Also, as a minority shareholder, when we invest in the listed company, we want to know who are the majority shareholders, what is their reputation. We also want to know the management track record. And for some stocks, especially when we talk about from the perspective of institutional investors, we want to know whether a particular company is included as part of an index. Remember, I talked about the investment objective, investment target. Some institutional investors, their mandate is a relative return, and that basically means their objective or their mandate is to beat the index. So they would need to know what are the stocks that are in the particular index. And when we talk about buying and selling shares in the stock market, we also want to know how liquid a particular company is, meaning to say that if I want to sell a particular company, can I readily dispose of all my investments in the stock market without moving the share price too much? And last but not least, we can have a company that shows very good earnings growth, very sustainable earnings growth, very healthy balance sheet, good shareholders, good management, and so on. But at the end of the day, it must boil down to valuation, whether valuation is attractive enough. In other words, in layman's term, whether the valuation is cheap enough for investors to buy a particular stock. Okay, and what is more interesting is from a fundamental perspective is we want to know what can actually move share prices. The short answer to that is anything and everything under the sun, and we do not need to look too far back. As an example, we have the usual corporate news that can actually move the share prices. Like, for example, if company ABC announces very good results, that may move the share price, or company XYZ decides to declare special dividend, that will also move the share price. Another good example is when there's a privatization of a listed company at a premium to the prevailing share price, that will obviously move the share price. But outside the financial context, you can have other factors that can also move the share prices. And we all know how impactful the COVID-19 pandemic has actually changed the world, including the financial market back in 2020 and 2021. And more recently, events that are outside the financial world, like the invasion of Ukraine by Russia, will also affect the stock market. Okay, so that basically gives a very quick overview in terms of how a fundamental analyst look at the stock market in terms of how to pick the winning stocks. Next, we will just move on to technical analysis. This approach is actually a bit more layman. It's actually easier to understand by retail investors. But if you were to go into the bookshop, there are just so many books out there for you to choose and pick, right? So, and personally, I find that this book, Technical Analysis of the Financial Markets by John J. Murphy, is an easy to read book. Okay, if you want to do a bit more in-depth reading, you can actually look up for this book. Okay, so some very basic notes of technical analysis. Let's start with the definition. Essentially, technical analysis can be defined as the study of market action, primarily through the use of charts, for the purpose of forecasting future price trends. So pretty straightforward there. And technical analysis is actually based on three premises. The first one is market action discounts everything. As I mentioned earlier on in the earlier slide, where I showed what are the potential factors that can actually move share prices, there's just so many factors. And technical analysis, when we talk about the share price action or share price chart, it will essentially capture whatever that can actually move the share price, be it fundamental, political, health, or even investor psychology. That will all be reflected in the price of that market. And the second premise is that prices move in trends. And we also believe that history will repeat itself, whereby the future is a repetition of the past, and that is based on the study of human psychology. If we want to talk about technical analysis, we have to look at the Dow Theory, which essentially is the cornerstone of the study of technical analysis. There are 6 basic principles under the Dow Theory. Number one is that the averages discount everything, which in a way, it's explained a bit more from what I have just shared in the previous slide. And market always move in 3 trends. You can see the primary trend, like a multi-year, whether it's a bull market or a bear market. Then you have the secondary trend, where prices can fluctuate from month to month, and the minor trend, where chart prices will move on a day-to-day or week-to-week basis. And the analogy used by the technicians would be that this essentially is what we can actually see out in the sea, where the primary trend is the tide, the secondary trend is the wave, and the minor trend is the ripples. Okay. Yeah, I mean, the last point essentially is that uptrend is characterized by higher highs and higher lows, and so is a downtrend, which is lower highs and lower lows. Okay. And the trends actually has 3 phases. What is not so obvious at the beginning of the trend is it is actually the accumulation phase, whereby the most sophisticated investors will start to buy, and prices then will start to move up. That's where we call it a public participation phase, where you can actually see that improve news flows and buyers buying interest will start to resume. And the third phase would be the distribution phase. Okay, that is when it's getting more and more bullish. When we talk about technical analysis, one key thing that we need to bear in mind is that we must always look for confirmation, meaning to say that if there is just one single technical indicator telling us there is a buy signal, that is not enough. We need to look at least another indicator to confirm that. And one of the ways to look at it is that if a share price is going up and that is backed by rising volume, that is considered one form of confirmation. And last but not least, in technical analysis, we always assume that a trend will always continue until it reverses. That's where you have that popular saying, the trend is your friend until it bends. Okay, some basic chart types, I won't spend too much time on this. I think it's good to be aware that there are many types of charts out there, depending how we want to plot it. Bar chart basically captures the open, high, low, close. Line chart is essentially just show the closing price data. We also have the candlestick chart, which is the Japanese version of the bar charts. And when you talk about construction of chart, it's actually very important to be aware that there are many time periods that we can actually plot a chart. It ranges from intraday or hourly or second charts, a daily chart, weekly chart, monthly chart, quarterly chart, as well as yearly chart. And you can actually see that when you try to interpret the chart patterns, as you switch from one time period to another time period, it can tell you a very different story. So it all depends on what type of investors you are. And if you recall, in one of my first few slides, I said that investment horizon matters for different type of investors. Chart patterns, very quickly, the more commonly talk about charts would be head and shoulder, double tops or bottoms, triple tops or bottoms, saucer and spikes. These are all considered as reversal patterns, meaning to say that if you see a head and shoulders chart pattern, and prior to the formation of the head and shoulder, the share price has been going up, the emergence of the head and shoulder pattern will essentially signify that it's going to be a reversal pattern going forward. The reverse of that would be the continuation pattern. We have the triangles consisting of symmetrical triangle, ascending triangle, descending triangle, as well as flags and pennants. Technical indicators, the more commonly used will be the moving averages. Even within moving averages, you have the simple moving average, the exponentially smooth moving average. We can also have the two-line moving average, RSI, MACD, stochastics, momentum. The point that I'm trying to make here is that when we talk about technical analysis, for those who have dabbled in technical analysis software before, if you dive deeper into it, there are just so many indicators out there, including the various variants, easily runs into hundreds of them. And from experience, the more technical indicators that you use, the more confused you can be. And as a result of that, you need to discover for yourself what works for which stock or which market. Right? It is essentially like a toolbox. I don't believe that there is a one size fits all. Right? So you need to have use various tools to fix various problems or to look at different charts. Okay. And if you want to compare technical analysis versus fundamental analysis, now very simply, technician studies the effect of market movements, whereas fundamentalists studies the cause of the market movements. And to me, there are benefits, advantages to be used in each of them. That's why a lot of people would actually suggest to use the fusion approach, where we use fundamental analysis to tell us what to buy, what to sell. Technical analysis will tell us when to buy, when to sell. Right. So at Kenanga Retail Research, we always try to combine both fundamental and technical analysis. If you are have been following our retail research, you can actually see that even when we try to call a technical buy on the stock, we will always include the fundamental story to it. At least as investors, when you are buying a particular stock, you know what you are buying into. Okay. And just to wrap up on the technical analysis section, technical analysis is all about reading market signals, but it certainly is not a foolproof forecasting tool. It's a means to an end and not an end itself. And I have pointed out, always look out for confirmation and also check out for divergence. And if you want to do a thorough technical analysis research, you should actually try to vary the time period, meaning you look at the daily chart, you look at the weekly chart, and you can also look at the monthly chart. And earlier on, I did mention that just because there are just so many indicators out there, it can actually be very confusing. And one way to solve the confusion is we actually try to apply technical analysis by building trading system, a topic which I will talk a bit more in a bit more detail later on. Let's move on to the topic of investor psychology. And I guess this is a subject which most of us can relate to. What exactly is stock market psychology? Is essentially is the study of investors' behaviors. And as investors' behavior, they have their influences on the share market performance. We all know that our behavior can be driven by our greed, our fear, our panic. We also tend to follow the crowd. That's the herd mentality. And very much also our behavior is driven by our individual personality, whether we are the conservative type or the aggressive type. And at the end of the day, when you combine all these human action, the effects are all reflected in the stock market. Because of the herd mentality, the stock prices or the stock indices tend to overshoot on both sides, upside as well as downside. And because of the herd mentality as well, we have the contagion effect, where it can actually spread across the board. And using investor psychology, the approach that we can actually learn from is that we try to gauge and predict the investment behaviors. Let's now try to do a bit of a simulation by looking at the investor's emotional cycle. For most of us who have actually invested in the stock market, I'm sure you can relate to this experience. When you decide to buy a stock, initially you are full of optimism, right? After buying, if the stock hasn't moved, then you will start to test your patience. And after holding on to it and the share price starts to move up, what's going to happen next? You feel very excited. And because of the rising share price, you would, once it hits your objective, you actually take profit. And with the winning money, you may actually increase your investment in your next buy. And this goes on and up to a point where you be very euphoric because you have been making money, and because success breeds confidence, you continue to put in more and more money. And if you were to be overcome by your own emotion, things can actually go wrong if you do not read the market correctly. And when things started to turn with a much bigger position now, you will be facing a bit more anxiety. And even at that point in time, because of what has happened in the past, you will continue to feel confident. You'll probably be living in a state of denial. And as a result of that, just based on the emotion alone, you will not be looking to cut your losses. And share price starts to come down again. And that's where the fear comes in. And at the very bottom, you will do the panic selling by following the market. And after that, the cycle repeats, right? You will get back into the market and so on and so forth. So this is essentially captures a typical emotion cycle of investors who invest in the stock market. So, just to dive deeper into the topic of emotion or the investor's psychology, right? There is actually, under investor psychology, there's a subject called behavioral finance, right? Excuse me. When I was asked to do presentation slides many years ago, right? This is just to digress a bit. I've been advised to actually try to source for the material from at least 2 books, not just 1 book. And the reason is simple. If you were to just take from 1 book, people may accuse you of plagiarism. But if you actually take your contents from more than 1 book, then they will actually call it research. Okay. In any case, the next 2 or 3 slides will actually try to summarize behavioral finance from the investor psychology perspective. And this topic itself where it's actually beyond the scope of this 1 hour session to talk too deep into it. But I have included 2 books that I have actually read to summarize these key points. If you are interested, you can refer to these 2 books and read a bit more. Okay. What exactly is behavioral finance? It is actually the scientific study of human behavior in the financial markets. And basically, it studies the human decision that cause price movements in the share price. The assumption here is that investors tend to be rational, but only up to a certain degree. And this essentially represents one school of thought when we talk about stock market analysis. This part of the session doesn't actually teach us how to pick stocks, but it does try to educate us in terms of controlling our emotions once we have identified a certain stock and decide when to buy or when to sell. And earlier on, I mentioned that investors tend to act rationally, but up to a certain degree. So why investors can be irrational? And these are some of the factors that can help to explain why we can be irrational at certain time. Point number one is what they call the prospect theory. Essentially, this is what they call a decision framing effect, meaning to say that different investors will react differently depending on how a situation is being presented. For example, if you are driving to work and you switch on the radio listening to the financial news, if the newsreader says that inflation is high, but unemployed people are low, versus if the newsreader were to phrase it another way, unemployed people are very few, but inflation is high, the effect can be very different to different people. That's because I think our mind tends to focus more on the first part of the sentence. So that basically underlines what prospect theory is all about. The second possible explanation is what they call mental accounting, whereby in our mind, we have a different account for different matters. And one very good example is, let's say, for example, you decide to buy a new handphone for your wife that is worth 1,000 ringgit, right? So you have bought it, but on the way back home, there is a snatch thief that has actually taken away the phone. So you lost the phone. Versus scenario 2, whereby you have withdrawn 1,000 ringgit and on the way to buy your phone, but along the way you drop the 1,000 ringgit. Okay, and the same loss of 1,000 ringgit is applicable for both scenarios. According to this mental accounting theory, under scenario 1, it's highly unlikely that you would go back and buy another handphone that is worth 1,000 ringgit. That's because in your mind, you have this handphone account, and when you were to buy it, it basically will double the cost from 1,000 to 2,000 ringgit. Hence, you'll be very reluctant to buy. Whereas under the second scenario, because what you have lost, the 1,000 ringgit, is the cash account in your mind. And there is always a likelihood that because you don't consider that as your handphone account, hence there is a possibility that you would fork out another 1,000 ringgit to buy the handphone for your wife. In the context of the stock market, how do we apply this? Mental accounting works in the sense that as retail investors, most of the time, we tend to segregate our paper loss or paper gains versus our realized loss and realized gain. Hence, there's always a tendency or a reluctance to cut loss because we do not look at it as a portfolio, rather we look at it in separate accounts. Loss aversion is another way to explain why we can be irrational at certain times. It basically means that we tend to look at losses more than gains. Take, for example, Take for example, if we are sitting in a position of 1,000 ringgit of losses in the stock market. Now, if you were to, for the same 1,000 ringgit in a falling stock market, the feeling is actually very different from 1,000 ringgit loss in a 1,000 ringgit gain in a falling market. Meaning to say that we tend to be more risk averse when we are facing losses and less risk averse when we are facing potential gains. The fourth possible factor that can explain why we can be irrational when we make decisions is the availability and interpretation of information. In today's context also, despite living in an internet age, information can be asymmetrical, meaning to say that information may not be accessible to everybody at the same time. We can also tend to ignore information, and what this means is that there can be selective perception. Let's say, for example, you decide you like a particular stock, and when you hear or read of news that that goes against your bullishness in the particular stock, you tend to ignore the information. But conversely, if you were to hear or read news that confirms what you think, you tend to amplify the piece of news. That is what selective perception is all about. Overconfidence is another factor that can explain why we are irrational, because we think that we can do no wrong. And lack of self-control is another factor whereby we tend to listen to the masses, we tend to follow the crowd. Having said all that, how do we be more objective when we try to make investment decisions? Number one, we believe that investment decisions should always be based on well-rounded beliefs. There must be reasons rather than prejudices. We also need to overcome the fear factor. And when it comes to the fear factor, it can be fear of losing. It can be fear of missing out. For example, if everybody jumps into a particular stock because of a certain trend, you have to ask yourself, are you doing it because of fear of missing out, or there is actually a fundamental or a technical reason for you to do so? We also need to overcome the greed factor. We talk about investor psychology, the various behaviors, and one of which is greed. Control over trading is another factor that we need to bear in mind. Basically means that there's actually no need to be in the market all the time. And speaking of which, if things do not go along your way, we should always try to keep a distance from the market, just take a break. Reason number 6 is that we need to escape from the mind trap of hope. Remember the emotion cycle that I showed you earlier on, right? Where hope turns into depression because we were still living in a state of denial. So we must actually go back and ask why we were buying the stock in the first place and whether the reason remains valid at that point in time. Sentimental influence is another factor that we need to try to detach ourselves from. For example, if you have been making a lot of money from the glove makers in 2020 and 2021, you will have a certain sentimental value attached to these stocks. Hence, if a piece of news that says that it's going to be positive and asks you to buy into glove stocks, because of this sentimental influence, there's a tendency for you to follow suit without looking at the fundamentals of the company. Likewise, if there is a stock that you have been burned in badly before, even though things have changed because of the bad experience, you will tend to dislike it. And at the end of the day, because there's just so much news and so much information out there, we have to differentiate between fact and opinion. Okay, so to make use of market psychology as an analytical tool, we need to take control of our emotions. And because market has its own way to seek out human weaknesses. And at the end of the day, if you want to take out the emotion, we always want to know when to sell before you buy, not after you buy. Just give me a minute. Excuse me. Okay, let's move on. So far, what we have covered is that when we talk about the various stock market research methodologies, we have touched on fundamental analysis, we have touched on technical analysis, we have also covered investor psychology. And the last bit here, we are going to discuss about trading systems. What exactly is trading system? It can be defined as a set of self-defined rules based on technical indicators to trigger buy or sell signals for the stock market trades. And just to illustrate, if I were to use a very simple indicator, which I believe most of us here can understand. In the study of technical analysis, if the share price cuts above the moving average, that is normally seen as a buy signal, right? And if you were to change the time period, the same chart may not appear, meaning to say that if stock ABC shows that the share price has crossed above the 21-day moving average, but once you switch it to, say, for example, 30-day moving average, the same signal may not appear there. So which is which? Do we believe the 21-day moving average signal, or do we believe the 30-day moving average signal? And the best answer to do that is to build a trading system. And when we talk about trading system, there are 5 steps involved. We always start with an idea, start with a concept. Say, for example, we want to see what is the best indicator to try to predict the share price of stock XYZ. Do we use moving average? Do we use RSI? Or do we use MACD? And once you have the idea, you turn it into objective rules, whereby you can actually check it out using a software, computer software. By plotting it in, you backtest it, and from there, we can actually look at the results to actually see for stock XYZ, for the past, say, for example, 10 years, when I use the 21-day moving average, what is the accuracy rate versus a 30-day moving average, what is the accuracy rate? And today, with the power of computer software, you can do optimization and backtesting, and you can actually compare and contrast the results for you to play around with the trading systems. So what are the main benefits of a trading system? Number one, like I mentioned earlier, you can backtest the ideas before you trade them, meaning to say that no real money is involved, so you can minimize your tuition fee. And you can also be more objective and less emotional. Remember, when we talk about the investor psychology, humans tend to be overwhelmed by their emotions. And when you have a trading system, it basically takes away the emotion part of it, meaning to say that once you have backtested the trading system, when a buy signal is triggered, that itself doesn't involve any emotion at all. And the beauty of trading system is that you can actually do more work, in the sense that it can increase the scope of your investment radar. We earlier on tried to compare fundamental analysis with technical analysis, and fundamental analysis involves a lot of in-depth work. Like, for example, you need to go through the accounts, you need to look at the financial of the company, you need to talk to the management. So for you to do such in-depth analysis, say in Malaysia, and you wouldn't have the benefit to actually talk to management for a listed company in China or US. that is a disadvantage of fundamental analysis. But when you talk about technical analysis, and by extension, when you build your technical analysis indicators into the trading system, whereby it captures the share prices, there's no need for you to go into the accounts or to talk to management, say, for example, Microsoft in US, because the trading system do not differentiate charts for a Malaysian company or a US company. Let's now look at this case study. This is Sunway Berhad, which is listed in Malaysia. This is a trading system which is built on RSI. Okay. If you look at for those who are familiar with RSI, basically when the RSI crosses above the predetermined oversold level, it will trigger a buy signal. And this trading system, this trading system shows that since 2015, there were 44 buy alerts being generated on this trading system, of which 37 of them has turned out to be profitable trades. What this means is that, remember earlier on I talked about how to build a trading system. So you need to have a self-defined rules. And for this trading system, what I have defined as a profitable trade is that the exit rule is either 13% profit or 13% stop loss. That is my exit rule. And once I put all this into the system, by backtesting on optimizing it, it has actually shown that by using this RSI indicator based on a certain period, since 2015, 84% of the time, the system has correctly predicted that whenever a buy signal is flashed on the system, the share price will subsequently go on to increase by at least 13%. And from this chart, if you look at the right-hand side of the chart, I have circled two most recent buy signals, here and here. And from these buy signals, which is out of the 7 buy signals, it basically suggests that the trading system, taking out the emotion part of it, is actually indicating to me that the stock can actually advance to at least 1 ringgit 77 cent to 1 ringgit 93 cent, with a support ranging between 136 to 148. I also mentioned earlier on, when we talk about technical analysis, we shouldn't just rely on one indicator. We must always look for confirmation. And we can actually do that by relying on trading system as well. And this is the second trading system, again on the same stock. And this trading system is built on stochastic indicator. And what I'm telling the system is that whenever the percentage K line crosses above the percentage D line in the oversold zone, it will trigger a buy signal. And for me to state what is the predetermined exit rule, I would impute it as a 12% loss versus 12% profit. By putting all these parameters into the system, after optimizing and backtesting it, the results come out to show that since 2015, out of the 57 buy signals that appeared on this system, 50 of them have correctly predicted that the share price would eventually go up by at least 12% from the trigger levels. This also translates to accuracy rate of 88%. Okay, I'll leave some of the questions in the Q&A session. Okay, I'm check. We have 5 more minutes. Having said all that, just want to highlight the fact that when it comes to stock picking process, there are obviously many challenges out there. And What are some of the more common challenges? This will include information overload. We all know that in the internet age, there's just so much information out there, and it comes from multiple channels. So we need to differentiate, and we need to have a way to filter through the information. And when there's just too much information, it tends to give us very mixed and confusing signals. Like the example that I've actually talked about when we use too many technical indicators. When we talk about stock market research, there is also a need to strike a balance between how in-depth, how comprehensive you want to be, and the timeliness of it. Because we cannot spend one whole month to look at a particular stock. We need to take into account the timeliness of it as well. And even more challenging is that because of the information overload, we do not know how to differentiate between old news and new news. We do not know how to differentiate between real news and fake news. And just to break this down, okay, I have plotted this known unknown metrics. I know it's 9:30. This can sound a bit too deep at this hour of the day. I'll try to simplify as much as possible. Essentially, when we talk about information on news, we can, broadly speaking, break it down, simplify it into 4 quadrants. Okay, let's tackle the more simple quadrant first. On the top left-hand corner, we have the known knowns. Essentially, this consists of information on news that we are aware of and understand. It's pretty straightforward. For example, if Gamuda tomorrow announces that they have secured a 1 billion ringgit MRT contract. So it is something that is official, is already announced, the whole market knows, and chances are this piece of news would have already been factored in the share price. Let's talk about the bottom right-hand corner quadrant, which is unknown unknowns. Essentially, this is information on news that we are neither aware of nor understand. In other words, it refers to future outcomes, events that we cannot identify or predict. By mere definition of this, we wouldn't know what's going to happen. Hence, there's no need to focus so much on this quadrant. And a very good example is COVID, right? It's not in our lifetime that we have seen such an event before. Focusing next to the bottom left-hand corner, unknown knowns. This refers to information or news that we understand, but not aware of. Basically, it means that the information we already know is already in our hand, but the existence, the relevance, or the value has not been realized yet. A good example would be when investors invest in listed companies that are very R&D centric. They are pioneers in the forefront of technology, breakthrough R&D. So we all know that the information is really there, but whether eventually the technology would come to be monetized, that is an unknown. Switching on to the top right-hand corner, which is the known unknowns. This refers to information on news that we are aware of, but we don't understand. And in other words, it is actually things that we know we need to know. Okay, we know we need to know, but are not known yet. This very good example that we can relate to is the elephant in the room currently, which is the rising US interest rate, which is causing a lot of havoc around financial markets everywhere in the world. And we all know that because inflation continues to be high, continues to be elevated, the US Federal Reserve has no choice but to continue to increase interest rate. So that is the known part. The unknown part here is that we do not know yet how much more and how fast they're going to increase the interest rate. So it's a good example of known unknowns. So the purpose of the matrix is to put in perspective into which box when we try to decipher or digest the incoming news. And another key challenge that we face when we talk about stock picking or stock market research is we may know the piece of news, but we wouldn't know how much of the good news or the bad news already discounted in the share price. And last but not least, the timing of the entry and exit or the investment holding period, which varies from investor to investors, is also another challenge. Okay, my last slide. Some key takeaways when we talk about stock picking insights. I think it's very relevant in today's investment world. As investor, we should do our own research. Gone are the days where you hear rumors in the coffee shop, people ask you to buy, then you just jump in. I think you need to do your own research. And because of technology as well, there are so many analytical tools out there. So make use of them. It's like a toolbox. Like I say, there's no one size fits all. You need to know to use what tool, under what circumstances. Always think independently, ask rationally, like who is doing what, why is that happening? That would essentially help you to take control of your emotion. Identify share price catalysts. What exactly is going to cause the share price to move? Earlier on, I showed one of the slides. There are just so many factors that can actually move share prices. Look for confirmation, even especially in the case of technical analysis. And each of us, depending on our own characters or behavior or personality, we need to have our own investment research process, whether you have the time or not. And the key thing here is that there must be discipline in executing the investment research process. Like, for example, earlier on, I shared one of the investment habits is we need to know when to sell before we buy. So you must have a discipline to follow this and not be swayed by share price movements. Last but not least, it's an ongoing process, right? I have been in the industry for 20 over years and I'm still learning. So stock market research is essentially a never-ending learning curve. Right? Glad to stop here to take any questions.
All right, thank you so much, Yin Foo, for sharing with us stock picking insights and explore with us various research methodologies where we can use to evaluate stocks from fundamental point of view or from technical point of view from other unconventional way of evaluating the market and securities. So if you have any questions for our speaker, Yin Foo, today, please write them in the Q&A box and we will address them accordingly. All right. Write them in the Q&A box so we address them accordingly. All right, the first question I have on my screen here is asked by Kasim. Now, which valuation method should we use for different type of stocks or sectors? Can you give us examples?
Right. The short answer to that is that there is no hard and fast rule. So it all depends. Even for fundamental analysis, let me share this. Right, even for fundamental analysis, when we talk about valuations, for certain sectors or for certain stocks, we will use the price earnings multiple, right? For another sector, like for example, banking, we tend to use a price to book value. For those stocks that have very stable and recurring dividend returns, we can use dividend discount model. So it really depends. Within fundamental analysis, there are various ways to do it. Within technical analysis, you also have to discover yourself. You need to explore. Let's say, for example, moving average may work for this stock, but for another stock, it could be RSI, for example.
All right. So thanks for sharing some ideas, for banking, for dividend-based stocks. How about property? Do you use, price to book as well?
Property in the depressed market, we actually use price to book, but in normal times, we will use discounted cash flow.
Discounted cash flow.
Yes.
Okay. The next question is, why do you say cryptocurrency is an asset class? So that's asked by Eric.
Right. Okay. I put cryptocurrencies under alternative investment. Okay. So no doubt it is a very young asset class, right? Young type is the investment is still pretty new, not known to so many people. But before the crash, there was a bit of a hype asking people to invest in cryptocurrency. The big picture is that it is a form of investment. So as long as you can put money and get returns out of a particular underlying asset, you can consider it as an investment. And even though cryptocurrency today doesn't look that interesting or exciting, but I don't know whether you will make a comeback or not, but at least it continues to be a form of investment, and hence I park it under alternative investment asset class.
All right. Thanks, Info. Now we know that the general election 15 is the 15th general GE is coming up. So I see that there are a couple of questions here who ask about GE. All right. So what should we do if there's a hung parliament? So there's a question by Kong.
Politics, to be frank, is not my area of expertise. Even though I can say that politics as a subject, everyone will always have something to say. Okay, but maybe it's timely for me to refer you to this chart. Okay, where do you think the general election event fall into? And I would argue that it will come under the top right-hand quadrant. It's a known unknowns, right? It's an event that we are aware of, but we don't understand, in the sense that we know it is an event that can affect the stock market, but there's not enough information yet for us to try to quantify it, right? So the short answer to that is, in a scenario of a hung parliament, from the perspective of the stock market, investors do not like uncertainty. So when there's a hung parliament, that would translate to uncertainty, and market would tend to have a knee-jerk reaction if that event pans out.
All right, thanks, Info. So in your opinion, how should retail investors like us strategize or position ourselves for this election? Should we look into construction sector, or should we hold off from doing anything first until the election outcome is clearer?
I guess there's no ready answer to that, simply because, like I say, it falls into the top right-hand quadrant. So it all depends on the individual investors, whether you want to take a view or not, and eventually whether your view will turn out to be the actual event or not.
All right.
Yeah, like just to elaborate a bit more, if you are the conservative type and you do not want to make any assumption, then perhaps it's good to stay on the sideline. But if for whatever reason you have a very firm view in terms of what's the outcome, and based on that assumption, then you can position your portfolio accordingly.
Okay, understand. Now there's a question by a client who want to ask, may I know what is the arrangement to integrate the trading system with the can trade brokers system? Like, what is the application process like? What are the charges like, etc.? I'm not sure if you are familiar with that.
Not really. It's a technical question, which I'm not in a position to answer. Perhaps you can drop us an email. And I try to direct it to the right person, because there are so many systems out there. I'm not sure whether are you referring to the Cantrade system. Okay, if you are referring to the Cantrade system, you are an existing client. I'm sure there's a help desk or a contact person or a contact number for you to reach out to on our website. Or are you referring to our algo system?
Yep, just send us an email and then we will respond to that. All right. Now, the next question is by Richie. Is there any free software that we can use to do back testing?
Free software. I am not too sure whether the locally available softwares allow us to do back testing, but what I can share is that I am currently using TradeStation, which is a software from TradeStation, a US-based company, and they have two models. One is that you pay on a monthly subscription basis. The other model is that you put a certain amount of money in their accounts and use the money to invest, and the softwares are readily available for you to use. So as an individual investor, the last I checked is that there's actually no urgency for you to deploy the money. So you can actually park. It's not a lot. If I can recall correctly, it's a $500 a one-off deposit into the account, and then from there you have access to the software.
All right, thank you so much, Yin Foo. The next question is by Peter Chin. What is Kenanga's top 5 picks for Bursa stocks for the next 12 months?
Well, it is actually not within the scope of this webinar, but in any case, I can mention to you. Just give me a minute.
Sure.
Okay. If you are our client or have access to our research reports, our latest strategies, we have top picks. We like the banking sector. So we have buy calls on Maybank, CIMB. We also like the telco sector. We have buy calls on DG and Telecom. And another banking stock is the ABMB, Alliance Bank. Construction stocks, we like Gamuda. And consumer stocks, we like Berjaya Auto and Aeon. So these are our house picks for the fourth quarter.
All right, thank you so much, Yin Foo, for sharing with us. What are some house picks for the fourth quarter? Okay, now having said all these counters, right? Gunam Singh would like to ask, what do you think about the future of the glove counters? They seems to be in a never-ending downtrend.
From bystander perspective, I don't cover the glove sector, right? Based on what I read, it's facing a double whammy in the sense that demand is softening, and on the other hand, supply has increased a lot. So when you have a double whammy of low demand, high supply, that essentially would result in deteriorating fundamentals, and all these factors are actually reflected in the share prices. And just for the record, our Kenanga Research has an underweight call on the glove sector.
All right. Now, Kasim would like to ask, how should we invest during different time period? Like which asset class should we go into in which economic sector, or in which economic cycle?
Let me
And also which
go back.
country?
Okay, that's why this big picture is very important. So you need to do your own research, like what's happening and take a view what's going to happen. Let's say, for example, maybe not now, because remember I talked about the unknown known, where US Fed is expected to continue to increase interest rate, but we don't know how much more and how fast is it going to be. But at one point in time, perhaps when things start to get a little bit clearer, right? When inflation has peaked, when the Fed has more or less increased as much as they want, because there will always be cycles in the economy or in the financial markets. So when things start to turn, right, when interest rate has peaked, the reverse is going to happen, meaning the money that has flowed in back to the US would be deployed to try to find higher returns elsewhere. And the reverse, when the reverse happens, it will benefit the emerging countries like Malaysia. So it is an open-ended question. I cannot have an answer for you at the moment, but it's an ongoing process. And I think one of the key takeaways that I mentioned in this webinar is that you need to do your own research. And hopefully, by having a big picture, you can read a bit more and form your own assumptions.
All right. Let's do one last question to end the session today. How would you see the volatile market right now? Should we find opportunities in this difficult time?
Like you have rightly mentioned, the keyword here is volatile. So at the moment, in the near term, things do not look too promising because the headwinds are coming from multiple channels. Like what they say, we are being hit everything everywhere all at once, right? Locally, we have our own problems. Overseas is also so many challenges, not only depressing factors in the financial markets, like the rising interest rate, the elevated inflation. We have other things to worry about, like for example, the invasion of Ukraine. One thing leads to another. So because of all this, it doesn't look too encouraging at this point in time. But what I have learned over the many years in the industry is that never say never. Markets always move in cycles, right? So there will be a time when things will come back. Just that at this point in time, we do not know when, but we have to watch the space closely.
All right. So thank you so much, Yin Foo, for doing this segment for us, which is titled Stock Picking Insight. So thank you so much for the time. So let me share my screen. All right. For our next Can Trade webinar, it is happening on next Thursday. That is titled Live Chat with SNS Network Technology Berhad, one-stop ICT system and solutions provider. So if you want to get an overview and insights into SNS Network Technology Berhad, we are inviting their senior management to come to our Can Trade webinar to do a corporate presentation session. So you may register for this session. Let me give you the link. All right. So you may register for this session if you want to know about the business, the financial highlights, and as well as their growth prospect. All right. So do register for this session if you want to learn about this one-stop ICT company. All right. That's titled SNS Network Technology Berhad. Now, for those of you who haven't had a Kenanga share trading account, you may go to this website, which is www.cantrade.com.my/open-account-form to fill out an online form. So once you fill up your online form and let us know your interest, then we will arrange a friendly dealer representative to cater to your needs to open an account. And for those of you who haven't joined the Kenanga Trade to Win Telegram channel, you may also click this link that I've just given you in the chat group. You can go to Telegram to search for Kenanga Trade to Win, or click the link that I've given you in the chat group to find this Telegram channel. In the Telegram channel, we will always update, trading ideas on that may help you to get some ideas on how should you trade and navigate in a volatile market like this period. All right. So thank you everybody for your time, for spending a precious evening with us to learn about stock picking insights. So we also want to express our gratitude to our speaker today, who is a senior analyst of Kenanga Research, Mr. Goh Yin Foo, to share with us, what are the various research methodologies to evaluate securities. All right. Thank you so much, Yin Foo.
Thanks, everyone. Hope the market will be better. Okay. Good night, everyone.
Yeah. All right. Bye, everybody.